Hello and welcome to you all. The Microeconomics topics, and the topic is the production and the production function. So, first of all, I want to define that what production function is. A production function is the relationship between the quantity of inputs a firm uses and the quantity between the quantity of inputs which a firm uses and the quantity of output it produces. Means it is a relationship of the inputs and the outputs. What we are using is a firm, what we are employing is a firm or is a producer, and what we are getting, that kind of the relationship is called the production function. So to produce anything, outputs, or we can say that production is the function, it is the process through which we change the shape of the inputs to the outputs. So there are different types of the inputs used in the production. But to produce anything, we are using two major types of the inputs. One is the fixed input, and is fixed and cannot be varied. Repeat it again. I am going to repeat it again. That a fixed input is that input whose quantity is not going to change with the change in the output, just like the building. I am standing in this class. This class, if there are only 10 students, this class is the 20 to attend the class will not change. So buildings, the machineries, so some inputs they are very fixed. They are not going to change with the change in the output, especially in the short run. Later on, we will discuss the short run and the long run. Then a variable input. Another input is called the variable input. A variable input is that input whose quantity the firm can vary. We are going to change as a producer, as a firm. We can increase or decrease the quantity of these inputs, just like the raw material, just like the labor. Usually in the short run we use labor as a variable input. So the production function is the relationship between the quantity of output we produce and the quantity of input we imply or we use. So there are two inputs, fixed input, which does not change with the change in output, and the variable input, which changes with the changes in the output. The long run inputs and the outputs. The long run is the time period in which all inputs can be varied. These are the different time periods available to the producers. Depending on the nature of the firm, sometimes a very long time, a short period is long period for a firm. So it depends on the nature of the product. So the long term is the time period in which all inputs can be varied. It is the enough time period available to the producers in which they can increase the variable inputs, even they can change the fixed inputs. Even the technology can be changed in the long run. And the short run is the time period on which at least only one input is fixed. It is that time period, it is the shorter time period, it's the smaller time period available to the producers in which they can only change or they can only vary the variable inputs, but at least one variable or one factor or one input is fixed. So which is the short one, is a very small time period. So the total product curve, another term which is related with the total product curve, it shows how the quantity of output depends on the quantity of the variables inputs for a given quantity of the fixed inputs. We also draw the total product curve. Through this product curve, we show the relationship of the quantity, the amount of the goods or services produced or provided of output depending on the quantity of variable inputs. You can see that production function and the total product curve for George and Martha's farms. Just suppose we have used it. Name is a symbolic name. Vertically, we have written the quantity of wheat bushels, and horizontally, we have written the quantity of labor or the workers or the number of the farmers. So you can see that the more quantity of laborers we are employing, the more output we are getting. Means it is rising, the total physical product is rising. Every second worker needs an increase in output of 17 bushels. If we say suppose initially we have gained 20, one farmer or one worker can produce 20 output from the lane, but when we are adding another worker, the second worker, with the help of the second worker, just suppose we have 36. Initially 19, second we can see 36. So the second worker has contributed 17 bushels. The third worker, when we are adding the third worker to the lane, same lane. Remember, the lane is not changing. Only we are increasing the number of the laborers, the variable input. So when we say that the third laborer or third worker, we have in total 51 output, 51 bushels, it means the second worker third worker has contributed 15 more. You can see here, this one, the fourth worker 64, the fourth worker has contributed 13, is a marginal product. Fifth worker 7, our total is 75, and 11 is the contribution of the fifth one. Sixth worker, when we have the 6 workers working in the field, the total is the 84, but the contribution of the 6th laborer is only 9, and 7 we have total 91, but the contribution of the 7th one is the 7 bushels. 8, when we are employing 8th worker on the same lane, same size lane, then the output is to 96 bushels, and the contribution of the 8th worker is 5. So you can see when we employ this data that 88 is 7th worker leads to an increase in output of only 7. You can see the 7th one is contributing only 7 bushels. So more you add the variable input on the fixed input, then the less will be the marginal product of the additional input. So the marginal product of labor, what is known as the marginal product of the labor? Here we say that when we are adding one more, marginal means additional. Output, in this case, the output produced by one more laborer. As we have discussed in the previous example, you can see that when we have 0 input or labor, we have nothing to produce. When we have replicated the first one has total output is 19. When we have added second laborer to the same lane, the total is 36. But how much contribution is made by the second one? When we minus 19 from 36, so the 17 is the contribution of the second one, and so on. So this So the marginal product of an input is the additional quantity of output that is produced by using one more unit of that input. Means when we are adding one more unit of the input, how much we are getting is the output, additional output. So the marginal product of labor, to calculate the marginal product of the labor, we simply divide change in quantity of output divided by change in quantity of labor. So the change in quantity of output generated by one additional unit of the labor. So marginal product of labor, L for the labor, M for the marginal, and P for the product is equal to change in delta for the change in quantity of the output divided by the change in L means labor. So this is the formula we simply use to calculate the marginal product. Diminishing returns to an input. Remember that when you are adopting, when you are applying more variable input on the fixed input in the shorter run time period, because you are only allowed to change or vary or increase or decrease the variable input. So diminishing returns to input. When we add one more worker or one more input, the output produced by additional input is less than the previous input. When we get such kind of the output, we say that there is a diminishing returns to input. Diminishing means decreasing. So there are diminishing returns to an input when an increase in the quantity of that input means when we are adding or when we are increasing the quantity of that input means labor. Holding the levels of all other inputs fixed. As we have discussed that in the short run we have to keep all other inputs fixed. They are not going to change, only the variable inputs will change. Leads to a decline in the marginal product of that input. When we apply more of the variable input, the output we get from that added input will be less than the previous input. If suppose I say that when we add one laborer, that one laborer is producing 10 markers per hour or 10 markers per day on a particular machine or on a particular type of the environment. When we add second laborer to the same machine, our total output is 18. Now, how much the second laborer is contributed to the production? We say that 8 is the contribution of the second. So it is called the diminishing return. Means second one is produced less than the first one. So following marginal product of labor curve, illustrate this concept clearly. You can see this marginal product of labor curve. Marginal product of labor means bushels per worker. These are the number of the bushels output per worker. This is the quantity of labor, the workers. When we say that first one, when we have the one laborer, we have such kind of the output. You can see the more the laborer you are getting, there are diminishing returns to labor. The first laborer is produced, suppose 17 or 18 laborers. The second one is produced 15 or 14. The third one is produced 13. The fourth one is produced 12. The fifth one is produced, just suppose, less than 12. Sixth one is produced 8. Seventh one is produced, just suppose, 7 or 6, and so on. It means more you aid the labor, the less output you are getting. So this kind of the output is called the diminishing marginal return. So to draw the total product, marginal product, and the fixed input on the same graph paper, quantity of wheat in the bushels written vertically, the quantity of labor means the workers horizontally written. Total product is the 20. The total product is the 10. So you can see this is the first level. You can see marginal product of labor, bushels per worker. Quantity of labor, this line, these are the two lines of the total product, and these are the two lines of the marginal product of the labor. Means more you aid the laborer, the less output you are getting. And total cost curve for the George and Martha's firm. You can see that more workers we are adding, the quantity of bushels is written horizontally and the cost is written vertically. The more bushels you are going to produce, the more cost, there is a total cost is increasing, but it is just rising. Output is decreasing. You can see cost is increasing, but output is decreasing. With a decrease, it is also increasing, but with a decreasing rate. So, let's explain it again. The business firm. What is a business firm? A business firm is an entity that implies the factors of production, resources to produce goods and services to be sold to consumers, other firms, or the government. Means business firm is an entity, business organization is an entity that implies the factors of production, that uses the factors of production to produce or to get output and services to be sold to consumers. Consumers are the people who are purchasing the goods for their personal usage. And other firms, these are the businesses. They are purchasing the goods for further processing or for adding some sort of a value, or the governments, these are the buyers. So the managerial coordination in the business firm, the process in which managers direct employees to perform certain tasks. The managers, their responsibility, their duty is to direct or to manage the employees just to get some work done or just to perform certain tasks. Why do we have the firms? What is the reason? What is the logic that firms arise? In the first place, firms are formed when benefits can be obtained from individuals working as a team. We form the firms, or the firms are formed when benefits can be obtained from individuals working as a team, when it is better or it is more beneficial to get more output from the collective efforts rather than the individual efforts. So sum of the team production is greater than the sum of the individual production. In a state, suppose there are 10 people, they are working separately. Their total output is just suppose 100. But when we combine the efforts of 10 people in an organization, their collective efforts produce suppose 15 units. 150 units, and the individual effort is producing 100 units. So the team effort is the team production is greater than the individual production. So when someone says that by forming the organization or forming the business firm, we can get more output. What is the firm's objective? Why the firms are formed? The main objective of the firm is to maximize the profit, to get highest return, to earn highest profit. It is the main motive of the firm that they wanted to earn or maximize their profit at the last level of the profit. So profit equals to how we calculate the profit. It is calculated through the profit equal to the total revenue. Total revenue means it is the sales earning. What we produce, when we sell it, the quantity multiplied by the per unit price will give us the total revenue. And revenue doesn't mean that this is your profit. Revenue is different from the profit. And we have to minus the expenditure or the total cost which is incurred on the production of these things. So when we minus, if something remains in positive, then the firm will earn the profit. And if nothing remains, then the firm will suffer losses. Now here, explicit and implicit cost. There are two types of the cost. Usually we are concerned with the explicit cost. Explicit cost is that cost which we pay directly as a cash. And it can be recorded. It is recorded into the books of accounts. The cost incurred when an actual monetary payment is made, when we pay the cash, when we pay the physical cash, when we pay the monetary amount, and that is recorded into the accounting records also. And the implicit cost, this is not the visible cost, this is not in a real sense is a cost that we pay. A cost that represents the value of resources used in production for which no actual monetary payment is made. Here we are not making the monetary payments. In very simple terms, we say the implicit cost is the opportunity cost. It means the explicit cost refers to the firm's actual cash payments for resources, just like the wages, rent, taxes, etc. And the implicit cost, the opportunity cost of using resources owned by the firm or provided by the firm's owners. Opportunity cost means next best alternative which we have sacrificed or which we have not chosen. Require no cash payments and no entry in the firm's accounting statements. We are not going to record opportunity cost or implicit cost into the accounting records. Explicit cost and accounting profits. So, accounting, economic, and normal profits. There are different types of the profits are named with the different, they are given different names. One is the accounting profit. So, accounting profit is that profit which we can say is the physical type or explicit type. the difference between the total revenue and the explicit cost. What we have earned as a revenue when we minus the total explicit cost means what we have paid. The remaining amount is the profit, and that is the accounting profit. Economic profit, the difference between total revenue and total cost, including both explicit and implicit cost. Here we minus the implicit cost also. It is the difference between the total revenue and the total cost. It includes both the explicit and the implicit. But in the accounting profit, we only include the explicit cost, means the things we pay. So the normal profit means zero economic profit, can also be known as the normal profit. A firm that earns normal profit is earning revenue equals to its total cost, explicit minus implicit cost. This is the level of profit necessary to keep resources employed in that particular firm. Means even if a firm total explicit and implicit cost equal to zero profit, even we say the firm is earning the normal profit. You can see here, accounting, economic, and the normal profit. Total revenue minus explicit cost equal to the accounting profit. Total revenue minus explicit, including implicit cost, equal to the economic profit. Now, the production and the cost of production. Production and cost of production, fixed and variable inputs. What is the fixed input? An input whose quantity cannot be changed is output changes. So it remains fixed, at least in the short run, that when production increases, this does not change. The variable input, an input whose quantity can be changed, is output changes. Variable input is that input whose quantity can be varied, increased, just like labor, the raw material. The production, even if suppose, just we can take this example, the car manufacturing plant, here the fixed input is the plant, the factory. If the company is producing 0 cars or 100 cars or 1000 cars, the plant will remain same. But variable input will increase. Variable input means the raw material which is used in the production of the cars or the number of the laborers required to produce a car will change with the change in the output. So, production in the short run and the long run. Short run, a period of time in which some inputs in the production process are fixed to change. And in the long run, a period of time in which all inputs in the production process can be varied. In the long run, no inputs are treated as a fixed. Even technology can be changed. Marginal physical product. The marginal physical product, the change in output that results from changing the variable input by 1 unit, holding all other inputs fixed. Marginal means it is the output produced by an additional unit of input. Marginal physical product, MPP, equals to the change in quantity, means the output, divided by change in labor, means input. In the short run, as additional units of a variable input are added, when we add more inputs on a fixed input in a short run, the marginal physical product of variable input may increase at first. Initially, the marginal product of the added input may be greater than the previous one, but eventually, suddenly, or just after that, the marginal physical product of the variable input decreases. It starts decreasing with increase in the marginal input. So the point at which marginal physical product decreases is the point at which diminishing marginal return has set in. The point from where we say that the marginal product is decreasing. If we say that first one is produced 10, then 2, when we add the 2 or second level, the output is 22. It means second one is contributed 20. It means the third one is produced 7, less than 8, sorry, 8, less than the second one. So from the third level, we say we have the diminishing marginal return. Law of diminishing marginal returns. You are familiar with the law of diminishing marginal utility. But here, law of diminishing marginal with fixed input, marginal product eventually declines. Initially it may increase, but it starts falling. Inputs output will decline from a inputs. Means then we are adding more of the inputs, variable inputs and fixed inputs. Eventually, the marginal physical product of the variable inputs will decline. It is